What's up, and welcome to Wednesday and Victory's virtual workshop, where we create confidence and clarity for your financial life. I am Patrick Huey, still am, and today is April the 10th, 2024. Today, we're going to take a look back at the investing and economic themes so far in 2024 as we close out the first quarter. We're live once again this week, so go ahead. Feel free to post in the chat using the button I've highlighted, or if you prefer, you can message me separately via email or text. First of all, let's take a look at the S&P 500 year to date. That's the green line here. SPY is the S&P 500 exchange traded fund. So it tracks relatively closely to the index, not quite perfectly, but it's up 10.2% year to date. Take a look at the RSP, which is an ETF that tracks the S&P 500 if every single company in the index had the exact same weighting, which it doesn't. But this equal weighted index is up 7.14% year to date. And then I've got this one, FNGS. Now, FNGS is an exchange traded note that has some of the biggest tech names out there in it. It's got Meta, Tesla, NVIDIA, AMD, Netflix, Apple, Amazon, et cetera. All the stuff that you've been hearing about for the last couple of years and about how well it's doing. And sure enough, this year, those companies, those small portion of large tech companies are leading the market higher, up 15.5% year to date. Now, what I find interesting is to take that back a bit. And if we go back to January 1st of 2023, you see just how much these FNGS stocks have driven what has happened in the market, right? Up 125% in the last 5 quarters. Whereas the equal weighted S&P 500 is up only 21%. Then let's take it back even further to the start of the bear market in 2022. Well, what do we get there? Well, it's a different picture because to get to where those FNGS stocks are now, they had to go down 43%. And then the rally back brought them up to positive 34 over the last 2 years or so. S&P 500 is up 13 over that period. And the equal weighted index is up 7.6%. This is just showing you that the participation of this market has not been equal. It's been driven by, at least to this point, a relatively few number of stocks. Tell you what, let's also take a look at some other things that people care about. Let's take a look at a moderate investor, what they've done over this period. Okay, so AOM is an ETF that tracks the Dow Jones or S&P moderate index. And over that period, since the beginning of the bear market in 2022, through the end of the first quarter, they're still down 1.4%, even though the S&P has come rocketing back and is up 13.8. Okay, well, what if you're conservative? Well, this is a conservative allocation, AOK. And over that same period of time, it's down 3.17%. So moderate and conservative investors are still negative after the bear market of 2022. Why? Well, here it is. Here's the aggregate bond fund, down 9.45% over that time period. And that is because of interest rates. Okay. Just talked a little bit about S&P 500 index concentration. Here's another slide that shows the top 10 and bottom 490 stocks in the S&P 500 in addition to the index itself. And we're using price to earnings ratios here. Okay, the PE ratio of the top 10 and the remaining stocks in the S&P 500, the top 10 have a PE of 28.4%. The top 10 average is 20. So they're at 140% of their normal average. You can say that another way. and say they're at a 40% premium right now to their average. The remaining 490 stocks, they're currently at 18.3 times earnings, which is lower, but still not as low as their average going back to 1996. They're at a 17% premium. And the S&P 500 as a whole currently trading at 21 times earnings, and the average going back to 96 is 16 and a half times, so a 27% premium. History shows that the valuation of the top 10 stocks have not always been more than the rest of the index, but more recently they have been increasing given more excitement about themes like AI. Take a look at the weight of the top 10 stocks in the S&P 500. They're 33.5% right now. But the earnings contribution of those top 10 in the S&P 500 is only 25.5%. Most of the price growth up here has been multiple inflation or multiple expansion rather than earnings. Prices are going up, but earnings aren't going up as fast. This means that buyers of these stocks are getting them now in anticipation of future earnings, which is totally fine, as long as those future earnings estimates turn out to be more or less accurate. Otherwise, look out below. All right, next up. This chart shows the intra-year stock market declines, the red dot and the number, as well as the market's return for that full year in the gray bar. First, there's not much in the way of volatility here in Q1. The max peak to trough has been 2%. But that may be changing a little bit as we dive into Q2 with a couple of declines already of more than 1% just in the few days, trading days of this quarter, of more than 1%, and potentially another one today if today's action holds. But that is, dare I say, normal given the look of this chart. Declines can and will happen. It's how you choose to react to them that matters. And keep in mind that we have two major drawdowns here in the last 4 years, but only one negative year overall. Okay, so things can change very quickly. Speaking of changing quickly, the chart on this page shows real gross domestic product over the last 20 years. And after the U.S. economy recovered rapidly in 2021 following the pandemic, growth has been normalizing to that trend, 2% growth since 2001. The chart on the right shows a basic breakdown of the most recent quarter's GDP, showing that once again, no shock, consumption is the largest driver of the U.S. economy. It's important to keep in mind, though, the changes in GDP and recessions happen quickly. In the 10 prior recessions since 1957, the average GDP the quarter before was 3.4% and 3.6 and the negative 3.6% in the first quarter of the recession. Let me say that again. The average GDP the quarter before was 3.4 and negative 3.6 in the first quarter of the recession. Well, oddly enough, last quarter's GDP was exactly 3.4%. Let's take a look at the recent history of U.S. federal government deficits and debt, along with projections based on the Congressional Budget Office baseline. Now, this is for sure intended for mature audiences. Children and those sensitive to irresponsible spending may want to go ahead and avert their eyes on this one. The left side of the page shows how much the government spends each year, about $6.5 trillion, give or take. The chart also shows the sources of government revenue and how much the government is forced to borrow to cover spending. Well, about 24% of the federal budget comes from borrowing. You'll note that not only is spending, net interest and outlays, climbing during periods of crisis anymore, like in 2008 and in 2020, you'll notice that it's well above trend line just as a normal part of the year. And you'll also notice that the last time we had a surplus in the budget was 1998. Accumulated debts 2024, 2034, we're looking at 124% plus of GDP being the federal accumulated debt. And that's if they extend the Tax Cuts and Jobs Act that are currently in effect until the end of 2025. And if they don't, if they let them sunset, it'll only be 116% of GDP. Still higher than it has been, even during World War II. All right, federal finances, not so good. Consumer finances, actually looking pretty good right now. Consumer balance sheets held up remarkably well during the pandemic, thanks to massive fiscal support, and they're still looking good with assets far outpacing liabilities. Now, on the top right, we look at the household debt service ratio, which is the percent of after-tax income used to make payments on mortgages and other consumer debt. And after declining to a 40-year low during the pandemic, aggressive Fed tightening has contributed to higher household borrowing costs and a rise in this metric. But you can see we're still well below long-term trends. That's a positive for the US consumer. One negative, on the bottom right, we show flows of auto credit and student loans into 30-day delinquency. After remaining flat for most of the prior decade, we're starting to see a bit of an uptick in delinquencies for auto and credit card loans. And that's usually a leading indicator of declining economic activity and or recession. Let's take a quick look at interest rates and inflation. This chart has nominal and real interest rates from 1958 through today. This has been one of my charts for a long, long time, and it's one of my favorites. Interest rates have been falling for really about the last 30 years, since the early 80s when we had our last big bout with inflation, and have just recently started to pick up. As inflation continues to slow, notice we said slow, not go away, real yields should move higher and higher into positive territory. Again, as I've said, this is the best time in 2 decades to be a conservative investor and able to pick up good, safe yields above 4 and 5%, depending on the maturities. This bar chart shows the total return for the Bloomberg US Aggregate Bond Index, which we looked at earlier, each year since 1976, the inception of this index. And I drew this arrow to show you that we literally, in my lifetime, because I was born in 1974, have never seen anything like we saw last year in the bond market. The red dots show the peak to trough decline that occurred that year, similar to the stock chart we looked at previously. History shows that bear markets for bonds are usually more like koala bears than grizzly bears, given the average intra-year decline is just 3.5%. You just don't see a lot of volatility in the bond market, except last year. So be careful what bond exposure you choose right now, as rates may not be going lower as soon as some people thought. This is why, we've really focused a lot of our fixed income holdings into short-term treasury bills because of the safety factor and the guaranteed factor, and quite frankly, the interest factor. They're all positives right now with those particular investments. Is it time for a change? Well, this slide shows that over the last 50 years, there have been multiple different regimes of US versus international outperformance. In other words, outperformance comes in waves when it comes to foreign versus domestic investing. And after a long period of US outperformance, it's starting to look like we may consider other markets that could soon start to do even better. The stars seem to be aligning for international to potentially take over the baton from the US over the next decade. And those include cheaper equity valuations. It's just cheaper to invest there. The dollar could be weakening, and a combination of cyclical and structural investment themes that can help boost long-term returns. This is something we are going to be keeping an eye on, not just this quarter, but future quarters as well. Finally, this chart shows a survey from the Pew Research Center asking Americans how they feel about economic conditions. And we're giving the percent who are rating them currently excellent or good, and we're going all the way back to the year 2000. The results show that Republicans often feel better about the economy under a Republican president. Similarly, Democrats often feel better about the economy under a Democratic president because, duh, this is confirmation bias. You can find information to support your party, and you'll naturally ignore anything that disconfirms your feelings about that party. It's completely normal. Yet, average annual returns on the S&P 500 during the Obama administration were 16.3%. And during the Trump administration, were 16.0%, almost identical and higher, a fair amount higher, than the average return over the last 30 years. Also, GDP growth is typically not impacted by who is in office either, so forget about that piece too. Now, I expect we'll beat this particular drum frequently in the next couple of quarters. Hating or loving the government is not an investment strategy. Remember, I'm not here to start political arguments. That's what Facebook is for. Thanks for being with me today. Be on the lookout in the weekly briefing email for the next topic for our virtual workshop. Thanks, everybody. We'll see you next week.